Adrian Mowat, emerging market equity strategist, joining in. Adrian, hi, good morning. What explains this underperformance that India is witnessing? We're not reacting to good news from US cues, and we're faltering even our other emerging market peers. You think it's all got to do with election uncertainty?
I think there's a starting point, which is India did relatively well in 2018, whereas other markets were down substantially, including, let's say, China. China was down in the Asia market about 30%, 25% in MSCI. China, that's the best performing market year to date, plus 12%. India down 5% in US dollars. So I think you've got a degree of a reversal of some of last year's performance. But you've also perhaps got less of a recovery story in terms of the macroeconomic data. Again, India was okay last year. Economies, particularly economies like China, were very weak. There were a lot of sort of troubling issues for countries that were sensitive to a strong US dollar and to rising US rates, so particularly some of the Latin American countries, Turkey, etc. And with the changes that we've seen in Fed expectations, they've tended to benefit those countries that were struggling last year when the Fed was viewed to be more hawkish. Now, I do think there are some Indian-specific issues. There was an expectation that the BJP would form the next government. I think the confidence around that may be ebbing a little bit with the international investors as they look at the opinion polls and some of the state election results. So there may be a degree of wait and see. The final point I would like to make is when you look at the positioning of emerging market funds, so the dedicated EM funds that just look at that part of the world, they were quite overweight India moving into 2019. It was the correct strategy in 18, and it's proving not to be the correct strategy this year. So I think you are getting a degree of selling pressure there as these funds have to reallocate to some of the markets that are performing better in 2019.
The election outcome is not tomorrow, next week or next month. It's almost 3 months away. So for next quarter or so, next 2.5 to 3 months, are Indian markets likely to remain in a range? And when I say range, not going here, not going there?
Yeah, I think that's the risk in that there's not a great deal of incentive to position ahead of this major political event. So we run the risk that the indices are range bound. But it is important to remember within India that there is a large divergence in the return of stocks, even year to date. And so I think, when you look at that, it tends to be some of the more defensive names doing better, and perhaps a few of the banks that had issues last year seeing a degree of recovery this year.
Right, and the big question is, Adrian, why we have FIIs which are continuing to steer clear of the Indian equities. Incidentally, some data also suggests that FIIs who have been bearish on the banking sector as a whole have even reduced their holdings in over half of the BSE 500 companies. What is the overall sense that you're getting from FIIs as to why they're steering clear of India and when we might see some sort of a rebound in flows?
Yes, so at the moment, we're not seeing strong inflows into broad emerging market funds, although at least we've addressed the issue of large outflows, which was an experience of 2018. And I was saying earlier that coming into 2019, the EM positioning was overweight India. And I think what we're seeing is just a reallocation of the asset bets away from India towards markets like China, Brazil, Turkey, where you're seeing the stronger performance. Now, what we might see is if EM continues to rise, you begin to see some inflows into broader EM funds, perhaps some asset allocation by the global investor, and then the FII net numbers might start to look a little bit better for India as it gets its share of the flow of capital into emerging markets.
Adrian, in fact, stay with us. I'm going to quickly take it across to my colleague as well, Jayesh, and he's been culling out data on this movement or underperformance that India has been seeing versus other emerging markets. Jayesh, what is it that you've picked out?
So I shall no surprise that India has been a rank underperformer so far this year, but it's only correcting what we had done last year as well, because we had outperformed significantly in last year. Now if you look at the MSCI constituents and the top 4 weighted countries over there, India has been significantly underperforming with a return of nearly 1.5% on the downside for the year itself, with China and South Korea clocking double-digit gains. Also, if you have a look at the MSCI index itself, that is down up about 7.5%, with Taiwan also clocking in about 6.5% gains so far this year. But most of this can be attributed to the institutional activity, and in particular the foreign institutional activity that I'm referring to, because South Korea and Taiwan have seen nearly $4 billion and $3 billion come into their countries via the FII route, and Indonesia has clocked in nearly $1 billion, while India has seen an outflow of about $91 million so far this year, despite the fact that domestic institutions have bought to the tune of about 5,000 odd crores on a YTD basis. Also, if you have a look at the valuation, a little bit concerning on the front of India. So China clocks in about 10.5 times 1 year forward, while South Korea also is very close to that, 10.7 times 1 year forward. Taiwan trades at a multiple of 14 times, while India among the top 4 is the most richly valued at nearly 21.5 times 1 year forward earnings. So some of the reasons why India could have actually underperformed its emerging peers.
Thank you, and I think this is what Adrian has been flagging off, that 2018 was a great year for us. 2019 we are simply aligning with our outperformance. Adrian, to your mind, what lies ahead for Indian earnings? Election is an event. It's very difficult to preempt, it's very difficult to prejudge. But what we can assess today is the bent of crude, the trajectory of interest rates, and then derive that which way Indian earnings are headed.
Yeah, look, I think it's a really good question, and I was looking through some data on the results so far, and we've had quite a lot of extraordinaries to try and process. But you're really ending up with an underlying profit growth of around 10% for India, and I don't really see any delta in terms of that particularly accelerating as we go into through 2019. Into the calendar year, into the fiscal year ending March 2020. When we look at the data for India, yes, you've got a better story around the oil price. Perhaps you don't have the same inflationary pressure that we're concerned about, less concern about the Reserve Bank of India raising rates. But on a regional comparison, we can probably make a similar argument as well. So I'm sort of struggling at this point to see sort of Indian valuations looking relatively attractive, because it's likely to deliver stronger earnings than its emerging market peers. But it's a kind of a long answer. I mean, I go back to the sort of point I was making a little bit earlier. There's this incredible divergence in performance year to date within the Nifty stocks. And it feels to me, as a strategist, I can make some macro comments. But the devil is in the detail, and we're seeing some quite different trends in earnings, even within the same sectors.
Adrian, do you think aside of this, big overhang in elections, are also, concerns around NBFCs, the liquidity crunch that the system is facing? And of late, the corporate governance issues that we've been seeing with some of the Indian companies, and these are large groups that I'm talking about, I'm sure you're in the know, that also may be acting as a bit of a hindrance as to why people are not willing to deploy their money in the market just yet.
I think that's a really good point. So, you have to address all these micro stock specific issues. I was talking about the big divergence in performance, at the bottom of the list in terms of performers year to date. You've got the likes of India Bulls, but at the top of the performance, you'll get a yes bank. And so understanding the micro dynamics seem to be a key issue for investing in India. And perhaps that does discourage the global asset allocators who maybe feel it's easier for them with their particular perspective to focus on more macro aspects. and they might be discouraged from adding capital to India because of the sort of the devil in the detail, the micro being so important.
Right. Adrian, if I may go back to, what is the implication with respect to politics and what may potentially emerge in the month of May or June, how are you, reading into what the FII view is now? Because do you think they've pretty much baked in, PM Modi's return to power in the general elections? What is the fear if there could be a coalition? And how is, the FI community generally looking at the general elections as a market-moving event?
See, I would argue it's gone from having a huge amount of confidence that the current government would be re-elected to a moderation in that confidence. I still think it's the base case for the bulk of people you talk to, but their confidence in that base case has been ebbing as they've been following the opinion poll results, as the state election numbers have come through. So politics is perhaps more of an issue today than investors would have thought in December 2018.
So you talked about banks which have not performed well, Adrian, in the last year, and I'm assuming those are those 2-3 top corporate banks which are really the flavor of the season of late. Aside of that, what would you recommend buying if one were to take use of the current market volatility / weakness?
So I think when we look at the story in India, last year you had a big outperformance of some of the more defensive sectors, whether it be IT and the pharmaceutical sector, plus some of the FMCGs. I think I would probably still stick with the IT story, but one has to sort of maybe look at the consumer names and perhaps some of the two-wheeler names would be the right place to position. Unfortunately, with the auto names, globally, we're seeing huge challenges to the auto sector, whether it be around the use of diesel fuel, the emergence of electric vehicles, and the capex cost that involves. And obviously, for Tata Motors, you've got the real near-term risk of a hard Brexit.
Adrian, for the moment, the fear of trade war between US and China has taken a backseat. What was the key talking point and bone of contention for better part of 2018 somehow has not come up. But the deadline is ticking, tick-tock, tick-tock. Do you think markets are in for a surprise or markets are in for some relief and good news?
Yeah, you see, I think it's the sort of the balance of outcomes here is much harder to judge. There was extreme bearishness in December around the trade negotiations. Markets have subsequently rallied, particularly the emerging markets that are more sensitive to trade deals like Korea, Taiwan. And so I think we've got a real balance of risk here that if the trade deals do not go well, you will get another correction in markets. If they do go well, I think markets will continue to rally. But obviously, the level of that rally will be more modest than if you were getting the good news from the low points in December. It's really difficult to judge how the White House is going to react to these trade deals. We've seen the president having to give massive concessions around the wall. He may politically, one could argue, really want to come out with a really good China trade deal, or he may take the view that going hard on China would be viewed as good with his supporter base. So I'm perhaps a little bit more anxious around this trade issue than I was in December when markets were lower and there was less of a consensus around these deals going well.
Last question. Let me classify the time periods here. 1 year, 3 years and 5 years beyond. In all these categories, if you have to choose your best investment or best theme, how would you invest? 1 year, 3 year and 5 year beyond.
So, and you want different investments for all those different time periods?
I mean, if you feel that you have got one idea which fits all, why not?
Well, I would continue to be overweight IT. I would look as the two-wheelers as my approach to relatively liquid domestic consumption plays. If I'm taking a longer-term view, then it would be the higher quality private sector banks is what I would focus on. And then with regards to a major index component, reliance, it's really going to be how the telecom space consolidates and whether the Reliance Group can really extract a fair amount of value with its massive investment that it's put into telcos. And perhaps it can also add to that with success in the retail space, particularly the online retail space combined with the bricks and mortar retail space.
All right. Adrian, appreciate your time. Thank you for joining us.